Part 1. The Dream of Financial Freedom. Understanding Passive Income. The phrase, "make money while you sleep," has captivated the human imagination for generations. It speaks to a deep-seated desire for financial security, freedom from the daily grind, and the ability to live life on one's own terms. This is the essence of passive income, a concept that has the power to transform your financial life, moving you from a position of actively trading your time for money to one where your money works for you, tirelessly around the clock. For most of us, our financial education begins and ends with the idea of active income. We are taught to go to school, get a good job, and work hard for a paycheck. While there is nothing inherently wrong with this model, it has a fundamental limitation. Your income is directly tied to the hours you work. If you stop working, your income stops. This is the time for money trap, and it's a precarious position to be in, especially in an uncertain economic landscape. Passive income, on the other hand, decouples your income from your time. It's about building systems, assets, and investments that generate income with minimal ongoing effort. This isn't about getting rich quick or finding a magic money tree. Building passive income streams requires upfront work, investment, and a significant mindset shift. But the rewards, financial resilience, freedom, and the potential for early retirement are well worth the effort. This essay will serve as your comprehensive guide to the world of passive income for investors. We will explore a wide range of strategies, from traditional avenues like dividend stocks and real estate to the exciting possibilities of the digital frontier. We will delve into the mindset and strategies required for success, as well as the risks you need to be aware of. By the end of this financial lesson, you will have a clear roadmap to begin your own journey toward earning while you sleep. Part 2. Traditional avenues for passive income. Stocks and real estate for centuries. Stocks and real estate have been the cornerstones of wealth creation. They represent ownership in businesses and tangible property, and they offer a variety of ways to generate passive income. Dividend investing, your share of the profits when you buy a stock. You are buying a small piece of a company. As a part owner, you are entitled to a share of the company's profits, which are often distributed in the form of dividends. Dividend investing is a time-tested strategy for generating a steady stream of passive income. How it works: dividend-paying stocks, many established, profitable companies, often referred to as blue-chip stocks, pay regular dividends to their shareholders, typically on a quarterly basis. Dividend ETFs and mutual funds, for those who prefer a more diversified approach. Dividend-focused exchange-traded funds, ETFs, and mutual funds offer a basket of dividend-paying stocks in a single investment. Pros of dividend investing. Regular income dividends provide a predictable stream of cash flow, which can be used to cover living expenses or be reinvested. Potential for capital appreciation in addition to dividend income. The value of your stocks can also increase over time, leading to capital gains. Dividend reinvestment drips. Many brokerage accounts offer dividend reinvestment plans, DRIPs, which automatically reinvest your dividends to buy more shares of the same stock, harnessing the power of compounding. Inflation hedge. Many companies that pay dividends also have a history of increasing their dividend payouts over time, which can help your income keep pace with inflation. Cons of dividend investing: market risk. The value of stocks can fluctuate, and there is no guarantee that the price of your dividend stocks will go up. Dividend cuts. Companies are not obligated to pay dividends, and they can cut or eliminate them at any time, especially during economic downturns. Requires initial capital to generate a significant amount of dividend income. You need to invest a substantial amount of capital. Strategies for dividend investing. Dividend aristocrats. These are S&P 500 companies that have increased their dividend payouts for at least 25 consecutive years. They are generally considered to be stable, reliable. Dividend payers. High-yield dividend stocks. These are stocks that offer a higher than average dividend yield. While the high yield can be attractive, it can also be a sign of higher risk. Dividend. Growth investing. This strategy focuses on companies that have a strong history of consistently increasing their dividends. Even if the current yield isn't particularly high, real estate, building a tangible legacy real estate, has long been a popular investment for those seeking to build long-term wealth and generate passive income. It's a tangible asset that you can see and touch, and it offers a variety of ways to earn a return. Traditional rental properties, this is the most direct way to invest in real estate. You purchase a property, a single-family home, a duplex, or a small apartment building, and rent it out to tenants. Pros of traditional rental properties, tangible asset. You own a physical piece of property that has intrinsic value. Rental. Income. You receive regular monthly income from your tenants. Potential for appreciation. The value of your property can increase over time, providing you with a significant return when you sell. Tax benefits. You can deduct a variety of expenses, including mortgage interest, property taxes, and maintenance costs. You can also benefit from depreciation, which is a non-cash expense that can reduce your taxable income. Cons of traditional rental properties. High upfront cost. Purchasing a property requires a significant down payment, closing costs, and other expenses, management responsibilities. Being a landlord can be a lot of work. You are responsible for finding tenants, collecting rent, and handling maintenance and repairs. Illiquidity. Real estate is not a liquid investment. It can take time to sell a property, and you may not be able to get your money out quickly if you need it. Tenant issues. Dealing with difficult tenants can be a major headache. Real estate investment trusts REITs. If you want to invest in real estate without the hassle of being a landlord, real estate investment trusts, REITs, are an excellent option. REITs are companies that own and operate income-producing real estate, such as apartment buildings, office buildings, and shopping centers. How? They work. When you invest in a REIT, you are buying shares in a portfolio of properties. REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. Pros of REITs. Diversification. REITs allow you to invest in a wide range of properties across different geographic locations and property types. Liquidity. Publicly traded REITs can be bought and sold on major stock exchanges. Just like stocks. Professional management. REITs are managed by experienced real estate professionals, so you don't have to worry about the day-to-day management of the properties. Cons of REITs. Market risk. The value of REITs can be affected by the overall stock market, as well as by conditions in the real estate market. Interest rate sensitivity. REITs can be sensitive to changes in interest rates. When interest rates rise, the value of REITs may fall. Dividends taxed as ordinary income. The dividends from REITs are typically taxed at your ordinary income tax rate, which is higher than the tax rate for qualified dividends from stocks. Real estate crowdfunding. Real estate crowdfunding is a relatively new way to invest in real estate. It allows you to pool your money with other investors to invest in real estate deals that would otherwise be out of your reach. How it works: online platforms connect investors with real estate developers and operators who are seeking funding for their projects. You can invest in a variety of deals, from single-family homes to large commercial properties. Pros of real estate crowdfunding. Lower entry barrier. You can often get started with a relatively small investment, sometimes as little as a few $100. Access to larger deals. Crowdfunding gives you the opportunity to invest in institutional quality real estate deals that were previously only available to wealthy investors. Diversification. You can spread your investment across multiple properties and projects to reduce your risk. Cons of real estate crowdfunding. Platform risk. The success of your investment depends on the quality of the platform and the deals it offers. Illiquidity. Your money is typically tied up for a set period of time, and you may not be able to get it out early. Due diligence required. You need to do your own research to vet the platform and the individual deals. You are considering Part 3. The digital frontier, new age passive income streams. The rise of the internet has created a whole new world of opportunities for generating passive income. These digital strategies often require more upfront creative effort than traditional investments. But they can also offer incredible scalability and high profit margins. Peer-to-peer P2P lending, becoming the bank peer-to-peer P2P. Lending platforms have disrupted the traditional banking industry by connecting individual borrowers directly with individual lenders. As a lender, you can earn interest on your money by funding loans for a variety of purposes, such as debt consolidation, home improvement, or starting a small business. How it works: you create an account on a P2P lending platform and deposit funds. You can then browse through loan listings and choose which loans you want to fund. The platform handles the loan servicing, including collecting payments from the borrower and distributing them to you. Pros of P2P. Lending, potentially high returns. P2P lending can offer higher returns than traditional savings accounts or bonds. Diversification. You can spread your investment across hundreds or even thousands of loans to reduce your risk. Monthly cash flow. You receive regular monthly payments of principal and interest. Cons of P2P lending. Default risk. The biggest risk in P2P lending is that the borrower will default on their loan and you will lose your investment. Platform risk. The P2P lending industry is still relatively new, and there is a risk that a platform could go out of business. Lack of insurance. Unlike bank deposits, your P2P lending investments are not insured by the FDIC. Risk mitigation in P2P lending. Diversify. The key to success in P2P lending is to diversify your investment across as many loans as possible. Research platforms. Carefully research the different P2P lending platforms to understand their underwriting standards, default rates, and fees. Understand borrower profiles. Pay attention to the borrower's credit score, income, and other financial information to assess their creditworthiness. Creating and selling digital products. Monetizing your knowledge. You have expertise in a particular area. You can create and sell digital products to a global audience. The beauty of digital products is that you create them once and you can sell them over and over again with minimal ongoing effort. Types of digital products. Ebooks. Write a book on a topic you are passionate about and sell it on platforms like Amazon Kindle Direct Publishing. Online courses. Create a video course on a skill you have mastered and sell it on platforms like Udemy, Teachable, or Skillshare. Stock photos and videos. If you are a talented photographer or a videographer, you can sell your work on stock photo websites like Shutterstock or Adobe Stock. Templates and printables. Design templates for resumes, social media posts, or planners, and sell them on platforms like Etsy, software, and apps. If you have coding skills, you can develop a software program or a mobile app and sell it in an app store. Pros of selling digital products. High profit margins. Once you have created your product, the cost of delivering it to customers is virtually zero. Global reach. You can sell your products to anyone in the world with an internet connection. Low overhead. You don't need to worry about inventory, shipping, or other physical products. Associated costs. Cons of selling digital products. Significant upfront time and effort. Creating a high-quality digital product can be a time-consuming process. Marketing is crucial. You need to be able to effectively market your product to reach your target audience. Competition. The market for digital products can be crowded, so you need to find a way to stand out. Affiliate marketing. Earning from recommendations. Affiliate marketing is a way to earn money by promoting other people's products or services. When someone clicks on your unique affiliate link and makes a purchase, you earn a commission. How it works? You join an affiliate program for a product or service you believe in. You are given a unique affiliate link that you can share on your website, blog, or social media channels. When someone clicks on your link and makes a purchase, you earn a commission. Pros of affiliate marketing. Low startup costs. You don't need to create your own product. so the startup costs are very low. No. Need to handle customer service. The company you are promoting handles all of the customer service and support. Flexibility. You can promote a wide variety of products and services, and you can work from anywhere with an internet connection. Cons of affiliate marketing. Building an audience takes time to be successful with affiliate marketing. You need to have a loyal audience that trusts your recommendations. Reliance on third-party products. Your income is dependent on the quality of the products you are promoting, and the commission rates they offer can feel inauthentic if not done right. It's important to only promote products that you genuinely believe in. Otherwise, your audience will see right through you. Part 4. The Investors Toolkit. Strategies for success and risk management. Building passive income streams is not a get-rich-quick scheme. It requires a long-term perspective, a disciplined approach, and a solid understanding of the risks involved. Here are some key strategies for success. The power of compounding and reinvestment. Albert Einstein is often quoted as saying that compound interest is the eighth wonder of the world. The same principle applies to passive income. When you reinvest your earnings, you are not just earning a return on your initial investment. You are also earning a return on your returns. This snowball effect can dramatically accelerate the growth of your passive income streams over time. Diversification, the golden rule of investing. Put all of your eggs in one basket. Diversification is the single most important principle of investing. By spreading your investments across a variety of asset classes and income streams, you can reduce your risk and protect yourself from the inevitable ups and downs of the market. Due diligence. Research is your best friend before you invest in any passive income opportunity. It's crucial to do your own research. This means vetting the investment, the platform, and the people behind it. Don't just take someone else's word for it. Read reviews, check references, and make sure you understand the risks involved. Patience and long-term perspective. Building passive income is a marathon, not a sprint. It takes time to build a portfolio of assets that can generate a significant amount of income. There will be times when you feel like you are not making any progress, but it's important to stay the course and stick to your long-term plan. Understanding the risks. Every investment carries some degree of risk. It's important to understand the risks associated with each passive income stream you are considering so that you can make informed decisions. Some of the common risks to be aware of include market volatility. The value of your investments can go up and down with the market. Inflation. The purchasing power of your passive income can be eroded by inflation. Platform failures. If you are investing through an online platform, there is a risk that the platform could go out of business. Scams. Be wary of any investment that promises guaranteed high returns with little or no risk. If it sounds too good to be true, it probably is. Tax implications of passive income. The tax treatment of passive income can be complex and varies depending on the type of income and your individual circumstances. It's important to consult with a qualified tax professional to understand your tax obligations. In general, however, dividend and interest income. This is typically taxed at your ordinary income tax rate. Rental income. You can deduct a variety of expenses to reduce your taxable rental income. Capital gains. When you sell an investment for a profit, you will have to pay capital gains tax. The tax rate depends on how long you held the investment. Part 5. Conclusion. Your journey to financial independence. The journey to financial independence is not about getting rich quick. It's about making smart, informed decisions that will put you on a path to a more secure and fulfilling future. Passive income is a powerful tool that can help you achieve your financial goals. Whether that's retiring early, spending more time with your family, or pursuing your passions, we have explored a wide range of passive income strategies. From the time-tested avenues of dividend stocks and real estate to the exciting new opportunities of the digital frontier. Each of these strategies has its own unique set of pros and cons, and the right strategy for you will depend on your individual goals, risk tolerance, and financial situation. The most important thing is to take that first step. Start small, educate yourself, and be patient. The path to financial freedom is a marathon, not a sprint. But with a solid plan and a long-term perspective, you can achieve your dreams of earning while you sleep. The financial lesson is clear. By shifting your mindset from trading time for money to making your money work for you, you can unlock a world of possibilities and create a life of true financial freedom.